So we have just talked about entry B, which is done in the year of the effective retirement of the bond. Let's now look at what should we do in subsequent years. So in subsequent years, as we mentioned, the consolidation entry is star B. Star B, basically, how do we get star B? The star B entry, it is actually made up of two parts as well. The first part is basically in 2014, we have this B entry, right? So this B entry, we need to carry it over to year 2015. So as you can see here, all of the income statement account, which is loss on retirement of bond, interest income, and interest expense. So those are income statement account in 2014. And then to carry it over in 2015, they should have already been closed into retained earning. So to carry it over, instead of recording those income statement account, we need to record retained earning instead. So 110,814 plus 84,597 minus 94,665. So basically, you have these three accounts going to the retained earning for alpha at the beginning of the year. And then for the rest of the account, you just carry it over to the year 2015. So this is the first entry, the first part of this, the star B entry. And the second part is at the end of 2015. So if you view alpha and omega as separate firms, alpha doesn't know what happened, and alpha doesn't know or it doesn't care whom it purchased the bond from. And omega just doesn't care like who purchased the bond, because omega doesn't purchase it itself. So omega needs keep paying interest and keep recording it as interest expense. So keep paying interest, 90,000 interest. Interest expense it will record is 95,132. So those numbers, you can all find them from the amortization table. And the difference is 5,133. That is credit, and it reduced the discount on bond payable. From alpha side, alpha is receiving cash interest payment. It is recording it as interest income. The difference is a reduction in the investment in bond account. If you view two firms as one firm, nothing should be recorded. So the consolidation entry we should make here is we need to write off the interest income recorded by alpha, write off the interest expense recorded by omega. The cash payment just cancel it out by itself. We need to write off the reduction in the investment account recorded by alpha and write off the reduction in the discount upon payable account recorded by omega. So we just need to write everything off so that it will appear as if nothing happened. So this is the first part of star B entry. This is the second part. And if we combine those two parts, that will give you entry star B, which is debit retained earning for this amount. And then, so those, you can just figure it out yourself. It's very easy. You just combine those two entries. And this, so the same as what we did in entry B, there's actually an easy way to get star B entry. Instead of going through all of those general entries, star B entry just have two purposes. The first purpose is write off the bond from Omega's book. So if you look at what we have on Omega's book at the end of the year 2015, on Omega's book, this bond, the face value of the bond is still 1,000. However, after another years of amortization, the discount on bond payable becomes 43,552. And also the interest expense Omega would record during the year is 95,132. So those are the three important numbers. And then if you look at Alpha's book, at the end of the year 2015, the investment in bond account goes down to 1,046,228. And then the interest income account is 84,165. So basically, the consolidation entry start be, we just need to write off all of those accounts. So on Omega's book, to write off bonds payable of 1 million, write off discount on bond payable of 43,551, write off the interest expense recorded, which is 95,132. And then we also need to write off the bond from Alpha's book, the investment in bond, the ending balance 1,046,228, interest income recorded, which is 94,165. So we write off everything from those two firms' book, so that nothing related to this bond would appear on the consolidation as in the consolidated total numbers. And then this it is not going to be balanced. So the rest, in order for it to balance whatever amount, just goes to the retained earning for the parent at the beginning of the year. So this is another way of how we can understand this journal entry. And then, so just a very quick mention of, so what we did just now is when the alpha is using the initial value method. And what if alpha is using the equity method? It's basically if alpha has been using the equity method for start B entry, instead of debit retained earning at the beginning of the year for alpha, we debit investment in Omega account instead. So, but one thing to pay attention to here is the investment in Omega, these two accounts, can you cancel them out? The answer is no. Why? Because those are basically two different accounts. So this is investment in bond account. This is to write off what what Alpha recorded on its book regarding its investment in bond account for Omega's bond. And this investment in Omega's bond, investment in Omega account, this is an investment in equity account. This is an investment in the firm equity, in the firm Omega. And this is investment in Omega's bond account. So those two are totally different accounts. So that's why we cannot cancel those two accounts out. Yeah, so that's all I want to talk about regarding the consolidation when there's intra-entity debt transfer.